Hello and welcome to another episode of the Investing with IBD podcast. It's Justin Nielsen here, your host, and we're coming to you at our normal time, live at 5 p.m. Eastern, and it is Wednesday, March 4th, 2026. I almost said 2025. I'm living in the past. We got a great show for you. Returning is one of my favorite guests, David Keller. I'm going to go ahead and add those special three letters to the end of his name, CMT, because he is a chartered market technician. Gosh, there are so many things that you're doing now. Of course, David was the former chief market strategist for stockcharts.com, and now he's out on his own with Sierra Alpha and coaching, speaking. He's got his market misbehavior podcast, and you just do a lot of great things for educating folks. So, welcome back to the show, David.
Good to see you, Justin. Always a pleasure to join you.
Yeah, and great having you. Speaking of market misbehavior, you know, I feel like that's kind of what we've been dealing with for a while now. I mean, this has
Mm,
been such a interesting market in terms of how divergent, I guess it is. And I
yeah.
guess what I want to start with you, David, is just when you get kind of all of these mixed signals, I feel like it can be very hard sometimes to determine, okay, what path should I be taking here? Because again, if you looked at the Nasdaq or even the S&P 500, it would be like, well, this is not an uptrend. This is sideways. This is not where you want to be. If you look at the equal weighted indexes, I mean,
Mm.
those were punching into new highs, and even the Russell 2000 was looking pretty good for a while there. If you looked international, that was looking great. And then kind of this week, everything everything started looking all topsy turvy. So how do you make sense of things, for the trend that we had, let's just say a few weeks ago,
Yeah.
that was very very broad, but not inclusive of our major indexes, and now what we're getting where, gosh, things are getting hit so hard that we're holding up so well.
No, 100%, Justin. And there's been such an injection of volatility. I feel like market volatility with the VIX pushing above 20. That's what that means, right? It means the day-to-day movements in the indexes should be more significant. That's certainly what it feels like.
Hmm.
But the emotional volatility in 2026 has been much higher than the market volatility, right? I think that's been the reality of it. To your point, I mean, if you draw a horizontal line on the S&P 500 or the Nasdaq, you're going to go back to like last September, October, and we're kind of around the same exact places. So
Hmm.
what's happened is the major averages have been sideways. Now, during that period where the major averages have been sideways, there's been a ton of action underneath the hood. It's been about leadership rotation, right? It's been about relative movements. And I think relative strength, right? Assessing the relative performance of different assets, always important, but now absolutely crucial. Because then you'll see that, a couple sectors have been relatively weak in 2026, but not many, right? It's
Yeah.
technology, it's communication services, it's financials, but all the other sectors have been pretty decent year to date and have generally outperformed the benchmarks.
Hmm.
So what's happening is a lot of movement underneath the hood with the AI trade struggling with a bunch of value and now defensive sectors working nets out to major averages that are relatively sideways. So there are great opportunities if have a good consistent process of identifying decent charts, and I think they're out there.
Hmm. Well, to your point on the defensive side, one of the things that was really interesting again was just you look at XLP, the consumer
Mm,
staples, which is typically known as this is the place where folks hide. This is where the big money goes. When they have to, their mandate is to stay 95% invested, but they
yeah.
don't want to be in tech. So this is where they go. But this move, really kind of started at the beginning of the year and was, I mean, pretty phenomenal. And it wasn't alone. There were a lot of areas that were, I guess, what you would more consistently call value. I mean, whether it was the dividend,
Mm,
the high dividend payers, even lately, we've been spending more time talking about AT&T, I feel like,
yeah.
or Verizon, which are not typically the stocks that we're covering, but these are the ones that have been setting up. And even with all of this volatility lately, it's like this isn't showing anything. This isn't showing any problems at all. So I guess there's this very interesting, like, what's working is just not what we typically think of as bull market type stocks.
So you've hit on, I think, a crucial takeaway from the markets in 2026, Justin, which is there's a whole generation of newer investors, novice investors, mostly younger investors that have been investing for maybe a couple years to a little bit more. And in their limited experience, bull markets are driven by growth stocks. Bull
Mhm.
markets are driven by earnings growth potential from technology and communications, and that's the story, right? That's it. And so they haven't seen a bull market where it's not growth leading. They
Mhm.
haven't seen a huge rotation into defensive sectors, and seen a situation where AT&T and Verizon are outperforming Meta and Alphabet, which are the two biggest stocks in the communication services sector. But that's the reality of where we've been in. That move to defensives has been, in some cases, very sudden because in the fourth quarter, we saw a lot of value sectors, things like, energy started to work, but not really, but it was more about industrials, like defense names, materials, obviously in the fourth quarter did quite well. But defensive sectors like consumer staples, like utilities, were all kind of lagging behind. In the
Mhm.
new year, in January, and especially into February, that's where we started to see defensive sectors started to do very, very well. These are the bond proxies like utilities, real estate. These are low volatility, higher dividend paying areas of the market. They're really boring. They're not sexy. They're not the juice. But when they do well, that shows you, to your point, that investors, institutional investors that have to own stocks, they have to rotate somewhere. So they're going to rotate into defensive, low volatility positions. So if the benchmarks go down, they're going to go down less, and they're still going to have an income component. So I think the surge in those defensive sectors, probably the most concerning change I've seen in the market into February. And legendary technical analyst, the late Alan Shaw, would say, when the going gets tough, the tough get eating, smoking, and drinking. So the
Yeah.
fact that beverage companies, tobacco names,
Yeah.
food products all had a remarkable February, I think tells you a lot about that rotation.
Yeah, I mean, yeah, to your point, I mean, certainly one of the ones in the consumer staples,
Mm.
Altria. I mean, look at that move. It's just like from 55 up to 70, and it's not like, oh, well, of course they have this new technology that they've come out with. I mean, it's that's not what's going
Right?
on here.
It's
So
no.
yeah, it's yeah, very, very interesting. But yeah, I hadn't heard that phrase, but that's a good one.
No,
Eating.
and I think with the chart of Altria is a great example. I mean, I think this is where having a consistent process of reviewing the charts is so important
Hmm.
because and this has happened, I feel like every year for a while now, from like the you switch the calendar from December to January, and some groups, some sectors just completely turn on a dime. And I think you saw that with consumer staples from 2025 into January 2026. Consumer discretionary was outperforming consumer staples through most of 2025, certainly off of the April market low. And that
Hmm.
shows you it's offense over defense. It's things you want over things you need. That's the sign of a healthy bull market. You flip the calendar over to January, all of a sudden consumer staples, which was testing a 52-week low, all of a sudden surges higher and starts outperforming. Tobacco names, which have been kind of quiet and sleepy, start accelerating. And then as the year has gone on, we've seen more areas of that fairly defensive sector start to improve. But the turn was very quickly. So this is one of those times when I think it's helpful to not be complacent. If you just
Yeah.
assume that whatever trend was in place last month is going to continue, you miss some of the most important rotations in the last couple months. And I think the surge in defensive sectors has been a big one.
Hmm. So let's talk a little bit about strategy. So how do you go about setting yourself up? What kind of I guess routines do you set yourself up for to be aware of this? Because again, it's very easy, even if it's not complacency, like you're just looking in the wrong places,
Yes.
sometimes.
Yeah.
So how do you kind of build into your routine something that allows you to not miss these? And also, I guess the other part too, because we've had a lot of these kind of trends. I'm just going to use the Russell 2000 as an example. I'm
Mhm.
going to pull up IWM and I'm going to go to the weekly chart because it did feel like for a while here there were a lot of false starts.
Yeah.
This looked like it wanted to go so many times. In 2024, it kept on breaking out, and the trend would last maybe 3 days, maybe you'd get a week out of it and then it would base again.
Yeah.
So I guess the two-part question is how do you build a routine that kind of lets you know, oh, hey, a move is starting, and number two, that it's sustainable. Because, for a
Yeah.
long time, like with the Russell 2000, and it felt like for a lot of these areas, it would start and then stop, and then it would start and then it'd stop. So enlighten me.
I think so. No, no, great questions. And I think you hit on the key word, which is routines, right? For me,
Mhm.
I've built my investment process over the years to realize, and I think to acknowledge the fact that it's not about being the smartest person in the room. It's not about having the world's most perfect investment process. It's showing up every day, every week, every month with intention and
Mhm.
making sure you're gathering evidence. If you're not gathering evidence, then you're falling victims to emotion. Then you have an emotion based investment
Right.
process, right? In the lack of evidence, you're just going to emotionally react to something you see or hear in the news. Big time an issue right now with events in the Middle
Yeah.
East unfolding very rapidly. We want to get away from an emotion based process to an evidence based process. And the only way you can do that is if you have a consistent process of evaluating the evidence and thinking particularly about what's changed, what's new, and what's different. So
Mhm.
for me, that means three of the most important things I do through the course of the year. One is my weekly process, then my daily process, then my monthly process. And to summarize it, the weekly process I do over the weekend when the markets are closed. It is
Mhm.
a take a deep breath, take a step back, and just sort of evaluate what did I learn last week? What was new? What was different? What am I thinking about in the week to come? What levels, patterns, signals are most important to me? What we don't want to do is every day overreact to the flickering ticks of the market and completely overhaul our investment thesis because of the flickering ticks of the short-term movements. So the
Mhm.
weekly routine for me is vital. The daily routine is a process I think of reflecting on what's new, just sort of seeing what has changed from that deep thinking you did over the weekend. So what moved, what broke out, what broke down, and that over my career, market surge has been and market surge's predecessors have been a key part of that for me, which is every day let me look at stocks making new 3-month highs. Every day let me look at stocks starting to break down on a relative basis and being able to just review what's starting to work, what's starting to not work, and make sure that I'm aware of it. And then the monthly process, which I just did earlier today, is take a huge step back, reflect on long term trends, weekly charts, monthly charts, and just think about how the market is evolving from one month to the next. So I would say for a lot of investors, the problem isn't that their crystal ball is broken or they need a better, more shiny one. It's just they don't have consistent routines. And so
Yeah.
inconsistent routines lead to inconsistent returns in my experience.
Hmm. Such wise words. And I want to kind of drill down on a couple things because
Mm,
I absolutely believe the evidence based approach.
mm,
It's just so important. Gather the data, really kind of look. But I guess one problem sometimes is um, we have a tendency to sometimes seek evidence that maybe maybe goes towards our thesis. Kind of like that bias. And that can be a problem. So how do you kind of ensure that you're kind of looking at the evidence cleanly, that you're
yeah.
looking more broadly and not getting kind of swayed by your own again emotional
Yeah.
baggage that you're bringing to it.
You're alluding to one of the most, I think, painful and frustrating of the behavioral biases, which is confirmation bias, right?
Right.
So what we want to do, to your point, is we want to gather evidence and then make our decision based on the weight of the evidence. But we usually and often can get that backwards, where we make our decision first and then
Hmm.
we gather evidence to raise conviction on a decision we've already made. So our
Yeah.
evidence gathering process is more to nurture our fragile egos and less to make a better, more informed decision.
Hmm.
So how do we fix that? Two things that come to mind. Number one, the consistency is a huge help
Yeah.
because when you do it inconsistently, right? If I just decide, uh-oh, the markets are changing, I might want to check in, you're already probably, you've heard something, you've seen something that's caused an emotional response, and now you're looking to charts, you're looking to gather evidence as a way of helping you process those emotions. And so you're already setting yourself up for failure. But if every day you look at the same set of charts, it's less about an emotion because you're going to show up every day and just evaluate what's new, what have the lines done differently, what's broken out, and it's more about the changing evidence from one day to the next, from one week to the next, and less, so I think it's the intention with which you're approaching that process is key. And then I think the second part, to be honest with you, and this is something I always suggest to people just getting started, is write things out, like old school pencil and
Yeah.
paper. What are the things that you would help you decide that I need to be bullish on this stock, or bearish on this market, or whatever it is, and then write out the answers, literally hand write them out, because it's very easy for us to tell little white lies in our head, but it's hard for us to write that down and sort of say, it doesn't look good. So writing it out, right? Is the trend up or down? It's up. Okay, good. That I've confirmed it. And then over time, hopefully, you become comfortable enough with that, and have a humility and an honesty to what you're doing, that you don't need to write it down by hand anymore. And hopefully, I'm past that formative process as an investor. But early on, that helped me a great deal. And when I've taught technical analysis at the college level, I've told people, write out the answers to these 7 questions and show me the answers. Then you can tell me whether you're bullish or bearish. We love to get to the conclusion before we gather enough of the evidence. So I think having a consistent process helps that. I think writing down, and literally pencil and paper, don't forget the value of just putting it down like that. That has a magical impact, using the pencil and paper, connecting it to our thoughts.
Yeah, no, I'm with you. And in fact, sometimes if I find myself struggling, sometimes you have to go back to the basics, right? And so, yeah, while I would love to believe that I'm above that, and I've matured enough to be beyond that, sometimes I feel like that's what I have to do. And
Yeah.
Bill O'Neill, the founder of Investors Business Daily, he loved sports analogies, and especially baseball. He would liken it to spring training for baseball players, right? What
Mm,
do? They go and they work on their batting stance. They work on fielding ground balls, and just all the basics. That's what they do. And you're like,
yeah.
these guys are paid millions of dollars. Don't they know this? Well, yeah, of course they do. But or even looking at John Wooden, who was starting a practice with, this is how we're going to put on our shoes. We start with our socks, and this is how we put on our socks. And you're like, come on, these are grown men, that are 7 feet tall. In the case of Kareem Abdul-Jabbar, I mean, you're really going to teach them this? And that's what he did. It was back to basics. So yeah, I think that there is a value to sometimes taking that step back. Well, I'm going to since I'm going to turn this a little bit into my own therapy session. So going back to the Nasdaq, I'm going to go ahead and share that here.
Mhm.
One of the issues I kind of struggle with in a environment like this is that I kind of feel like I don't have an edge, right? I
Yeah.
just you mentioned humility, and I'm gonna chalk this up to my own humility, to where when I see an environment like this, and such volatility, you mentioned the VIX, which again is also known as the fear index, and
Mhm.
this got almost up to 30. It was right there at 28, kind of the same levels that we hit on these important days of October 10th and November 20th, that were real kind of shocks to the system. Um, with this extra volatility and news events, and I mean, sometimes I'm seeing these moves, I don't understand why, and then like I'll read the news and I'm like, oh, okay, yeah, that makes sense. But sometimes I feel like I'm not smart enough to get it ahead of time, right? And
Yeah.
so without an edge, sometimes I feel like, okay, I've just got to step way back until my edge comes back. Is that kind of the right way to think of things, or is it kind of throwing your hands up in despair?
Justin, I'm happy to serve as your therapist by proxy here this afternoon. So thank you for that. Thanks for letting me into your brain here for a bit.
Right.
Here's what I would say. Right in your question, I think is a good sort of awareness of the fact that what you don't want to do is trade your way out of a challenging period,
Yeah.
right? And that is a common temptation, right? When things aren't clear, we tend to overtrade, right? The tendency is, all right, I'm gonna force something.
Hmm.
And my son is 10. He's big into soccer. We always talk about waiting for the good opportunities. Same with any sport, right? It's not, don't force it just because the ball is there and you want to just kick it in a general direction. Like, there's going to be a moment where everything is set up right. Like, wait for that moment. And so I think we have a tendency to overtrade. And so fight that temptation by really focusing on the evidence and making sure, is the weight of the evidence telling me that this is a good use of my capital? Remembering the fact that when you tie up your capital in one trade, the problem with over trading or trading out of something is when you tie up your capital with a relatively meaningless trade, then you're not available. You don't have that capital
Yeah.
available when the really good opportunity comes along, right? So I would argue this has been one of the most sit on your hands kind of markets in 2026. I mean, the S&P and the Nasdaq have been dead sideways, right? They've literally been fluctuating. So as a swing trader, certainly some opportunities at the index level, but it's been a yellow light kind of vibe for me, looking at the chart of the S&P and the Nasdaq as well. So I think that's one important thing to think about. The second thing I would say is when you look at the chart of the S&P, when you look at the chart of the Nasdaq, remember that the market can go in one of three directions, right? It can go up, it can go down, it can go sideways. And we've gone in that third direction of sideways, which means unless I'm trading options and I have some sort of like straddle or strangle or something where I'm able to bet on the price remaining within a range, there's really not a lot of opportunity there, which means I need to look elsewhere. So use this as a time to focus on the charts that look much better than the S&P. They're out there. It's not
Yeah.
hard to find them. Focus on the charts that look a lot worse than the S&P. It's not hard to find those either. The final thing I would say, Justin, when you showed the chart of the VIX, think about what the VIX actually represents. And for those that don't understand it, not to turn this into a VIX masterclass, but the VIX is basically looking at the S&P index options and
Right.
looking at the movements of those options and then implying what the daily movement of the S&P should be. And I'm going to completely skip all the math, but a VIX around 16 basically means the options market's pricing in about a 1% daily move in the S&P. So a 1% move up or down should be kind of the expected normal day. The VIX has now gone above 16. It's now gone above 20. Earlier this week, it spiked up to the upper 20s, up to around 28. So with the VIX to that level, what it means is that the daily movements to the upside or the downside are just going to be heavier. We should expect more 1 to 2%, if not more, daily moves as opposed to 0.25%, 0.5% moves in the S&P. And for the last couple months, it's been a low VIX, and we've had relatively small changes in the daily indexes. Right? We haven't
Yeah.
had these big percentage swings; it's been small moves. Now we're just getting an elevated volatility, which means there's a lot of noise happening from one day to the next. So I think it's important to not draw long-term conclusions from short-term changes in the indexes, right? Make short-term decisions with short-term data, make long-term decisions with long-term data. So I would be spending my time not trying to dissect each 2-3% swing in the S&P and what today means relative to yesterday. I would be taking a big step back from the monitor and think about what has really changed from one week to the next, from 1 month to the next. And those changes are not at the index level. They are definitely underneath. And that's, again, where the good news is I'm not struggling to find opportunities. We just have to look for them elsewhere.
Yeah, and I guess that's one of the challenges. If you have been looking at the indexes and you're like, "Oh, this is sideways. This is a market I shouldn't be trading in." Okay, but then you look at certain individual stocks like a Lumentum, for instance,
Mm,
and you know you're sitting on the sidelines because you're like, "Oh, I'm trying to follow my rules and not trade in a sideways market." But then you see something like this and you're like, "Well, I'm missing the boat. I mean,
yeah,
this thing just went from 400 at the start of the year to over 700, and it wasn't alone. It's not
yeah.
like this is the only one. There were the whole group here. SanDisk, of course, leading the data storage, phenomenal move there. And even with the silver move that was
Mm,
happening, there were these moves all over. So again, it can be very hard. As you said, it's a good market to be sitting on your hands, but it's also a hard market to sit on your hands when you're
yeah,
seeing
yeah.
moves that are so tremendous.
And honestly, Justin, I think what I found is there are times, having analyzed the market through a number of different cycles, like mid last year, a lot of charts looked very similar, right? Especially the
Hmm.
growthy stuff's all kind of work. It's like the S&P and the Nasdaq are making new 3-month highs pretty consistently. A lot of stocks look very, very similar to that. Now, all of a sudden in 2026, that's not the case, right? There are some stocks that look like the S&P, but there are a ton of stocks that don't look like the charts of the S&P and the Nasdaq, and
Yeah.
that shows you there's a real dispersion right now from what's working and what's not working. And it's just that means the average is kind of sideways, but there's a lot of differentiation to be had. So
Hmm.
there are charts that look remarkably strong at this point. There are charts that look remarkably weak. There are some that look kind of like the indexes, but not many. And I think that tells you it's one of those times where you need to look down at the sector group and certainly at the single stock level for opportunities.
Yeah. Well, I'm gonna disagree with you on the average stock looking like the S&P 500 because
Mm,
the RSP, the equal weighted, it was kind of in an uptrend here, and I think
yeah,
that was another one of the things that was very tricky. So this was kind of telling me that the average stock was actually doing better than the S&P 500.
yeah.
That the Mag 7, of course, in 2023 and 2024, that was what kind of was driving the indexes. And I'll be honest, I did not have a great year in 2023. I was just in the wrong space. That was about buying the Mag 7 and
Mm,
kind of leaving, they talked about, oh, there's the other 497. I mean, the 493 that you just
yeah.
don't want to have anything to do with.
Yeah.
Now it's like, this was the 493 and just forget the Mag 7. It felt like
And
for a while.
we've pivoted from a period where not owning the Magnificent Seven was a performance killer, right? It's like if you didn't own Meta and
Yeah.
Microsoft during this great boom, it was really hard to outperform.
Yeah.
Now we're in a period where if you own any of those names, it's absolutely killing you.
Hmm.
And I think you're is 100% right, Justin. What you have to remember is the S&P and the Nasdaq, they're weighted averages, right? They're
Yeah.
heavily weighted and skewed toward the Magnificent Seven. So the chart of the Magnificent Seven looks about as bad as you would expect given the deterioration in those names. The equal weighted S&P, the advanced decline lines have all been making new highs in January, February, and now into March. And so again, that just speaks to how opportunities are out there. In some ways, this is a very easy market to outperform because you just need to go outside of large cap growth and you're probably finding some pretty good opportunities out there.
Yeah. And to your point earlier, this is where relative strength can really help out a lot. I mean,
100%.
just look at,
Yeah.
hey, what's beating the S&P 500? That's what this relative strength line is simply doing. It's a ratio of, it's this is actually not proprietary. This is you can do it in Excel.
Yep.
Are you beating the S&P 500 or not? And to that end, let's go ahead and talk a little bit about value because if you look at the S&P 500 growth, um, that looks an awful lot like the Mag 7 that we just pulled up. It looks very similar to the indexes, the Nasdaq
Yep.
Composite and the S&P 500. But if you look at IVE, the S&P 500 Value ETF, again, like RSP, maybe even more so, this just looks different. The value
Yeah.
the value part of the S&P 500. Um, I mean, what's not to like? Higher lows, higher highs, you know, getting support at the 50-day moving average line. I mean, this is kind of your picture perfect uptrend, right?
This and what's happening now, this could be one of those years where simply just being in the value space and not in the growth space is an easy way to start to outperform because that's just where the trends have been much more consistent there. It's almost like the value chart and the growth chart with the ETFs you're using, both looking very similar until like October, November, and then the growth ETF just starts to lag behind, kind of stalls out, and then the value ETF just continues higher. And if you
Mhm.
think about what's in the value ETF, right, that's going to be more weighted to sectors like industrials, sectors like energy, sectors like materials. Those sectors have all been performing and at various times stronger than others. The only value sector that really hasn't been particularly strong in 2026 has been the financial sector, and that's where you've seen a pretty decent downside rotation in the XLF. But
Mhm.
elsewhere within in the value space, pretty strong for sure.
Yeah, and that's another one so tricky because this
Mm,
breakout here in December, I mean, that financials were looking good, and
yes.
actually, if you looked at like the KBWB, which is specifically the banks and a lot of the money centers, I mean, this was looking like a solid uptrend, and it wasn't until things really started getting hit pretty hard, and this was not Iran related. This was even before that. You also I should mention I'm going to bring up VXUS because the Vanguard
Mm,
total international stock minus the US, so this is basically how well foreign stocks were doing. Just an incredible move, but the shock to the system, I guess, of the Iran attack, and I'm going to bring up just while we're at it, I'm going to bring up South Korea because I mean South
mm.
Korea, this ETF had gone on a remarkable move, and then within days, so again, how do you kind of mix that, take the step back, and look at the overall trend, but wow, something has really dramatically changed here,
Yeah.
and I need to do something.
So this is the challenge. The chart of South Korea reminds me a lot of like the chart of gold or silver, right? They
Yeah.
started having an exponential rise, right? There's sort of a normal kind of consistent trend, and then it really starts to accelerate. And what we honestly, as investors, we want to experience all of that exponential upside, but none of the exponential downside. And the problem is when things go vertical, right? And
Sign
they
me up
really
for
start
that.
to, yeah, when they really start to accelerate, you know how it's going to end. I mean, you
Yeah,
should, right? I mean,
yeah.
they tend to have these quick snapbacks, and we've seen that with the chart of gold, really sort of backing and filling in a very volatile 6 weeks. We're seeing that now in the last week with the chart of South Korea, with most of the developed European charts, Japan, others having these really choppy periods. I mean, I think it's important to, for me, this is like the immediate response is to look at the weekly chart, look at the monthly
Mm,
chart. Don't get too drawn into day to day movements. The daily chart is now going to become extremely volatile because we had an exponential rise and now we had an exponential drop, news driven shifts. The weekly chart tells you, is there enough of a shift in the trend that I really need to start meaningfully changing the bets that I'm making? So for me, I've been way more overweight non-US markets than US markets. And that's
hmm.
been the case for months because even, I mean, in 2025, non-US markets outperformed the US
Yeah.
pretty consistently, right? So this is not a new story. And the weaker dollar was a big part of that theme as well. So, I'm not completely reallocating out of non-US markets just because of what happened in the last 48 hours. Is it something I'm paying attention to? 100% yes. So I think people, should differentiate between something is moving quickly, I need to reevaluate versus something's moving quickly, I need to sell the position today. We don't want to make that big long-term allocation decision based on one day. So I think the challenge with a lot of those markets, particularly the non-US charts this week, is they're going to become a lot more volatile. Same with the chart of gold and silver. I would say those charts are still very good. They're just very noisy recently, but the long-term trends haven't shifted to the degree that I would be particularly concerned just yet.
Hmm. Well, one of the questions from YouTube live here is VICR, and I guess
Mm,
this one is in the electronic parts. It's industrial, military, test, and data processing. Anything that says data processing, a lot of folks or power components. People think, oh well, AI needs power, needs data centers. This is starting to kind of look, at a very steep angle. So
yeah.
again, is does this kind of bring in that expectation for you that yeah, you can participate, but you got to have that expectation uh, that you might have that exponential drop coming, or is it not quite long enough?
I mean, so this is the challenge. I mean, what a great problem to have is you own a name that's up a ton, right? I mean, like, if only that was the issue I always had as an investor was how to deal with these great gains that I have on paper.
Yeah.
But having said that, right? I mean, I think what you have to remember about a chart like this, it's in a strong uptrend. It's in a new uptrend, right? On VICR, it was a pretty big breakout in the fourth quarter. Right? That break above resistance was pretty meaningful. What happened after that breakout is what's so compelling. And this is why, breakout names, I often scan for stocks making new 3-month highs. And it's to surface charts like that where the initial breakout is followed by additional buying, right? Because what we don't want to see is a breakout that starts to get faded, where people think, all right, that was just a
Hmm.
one-off thing. Great, I can cash out. I'm seeing additional demand. I'm seeing people willing to pay more and more for that stock. So I think, I mean, William O'Neill obviously did some fantastic educational work teaching you how to start to trim positions when you're up X percent after a breakout, and I think that is one of the ways to think about it, right? I mean, if you have a great breakout and you continue to ride it higher, at some point it becomes a bigger and bigger weight in your portfolio. And if you're having
Right.
trouble sleeping at night, your position size is too big, which means we need to trim things. And so earlier, late 2025, I'm trimming my gold position a little bit, not because I didn't think it was an awesome chart, because it was just I didn't want it to be the Dave Keller gold retirement portfolio. Like
Yeah,
I thought it was a
right.
good bet, not the bet. I didn't want that to be the bet I was making.
Yeah.
And that's the problem, especially with smaller names when they accelerate and have huge percentage gains. Just think about your allocation, and that's something that institutional investors do very well, I think, of thinking about percentage weights. You think
Hmm.
about relative weighting, you think about active share, you think about what message am I conveying, what bet am I making, and what bets am I making with my portfolio. Individual investors just think about the returns and think, great, this is going up. But what you have to remember is when it grows, your bet is growing, and all of a sudden it
Yeah.
becomes the most important thing. So trimming that down on the way up is one of the ways to just make sure it's still a reasonable bet to be made. And then think in terms of levers that you can pull, right? When there's that initial pullback, we don't have to sell all of it, right? We don't have to own 100% of position or 0%. We can nibble. We can take little bits on the
Hmm.
way up. We can start unwinding a little bit if we're concerned that it's overextended. Remember that you have a lot of room between owning an entire position and owning none of a position. I hope individuals can think more along those lines.
Hmm. No, that totally makes sense. And I should also, you're bringing up kind of the way institutions think.
Mm.
For those that don't know, David spent a number of years with Fidelity, so I mean, you literally know how the institutions think. You've been there, and everything, and it's a good reminder that position sizes are not static, right?
Yes.
As soon as the market opens, everything changes, little by little, and you have to, again, that's where sometimes taking that step back and looking at your portfolio, looking at those weights, and saying, hey, is this is this where I meant to be?
Yeah.
Or did I just get there and I'm not making any changes there. Um, David, I also want to kind of address another big thing here in terms of as part of your routine, something that you mentioned as probabilistic analysis,
Yeah.
which sounds like something like ask your doctor if this is right for you. But what does that mean? What do you mean by that?
I love that. Yeah. So one of the things that I learned in my time at Fidelity was you don't want to put your blinders on. It's very easy to develop an investment thesis. Think, here's what I think is going to happen with this stock or with the benchmark or whatever. And then you put your blinders on and you immediately turn off your ears to any alternatives. And
Hmm.
one of the things that I learned, we would have frequent bull bear debates, right? If everyone was bullish on Apple, someone would have to be bearish on Apple. Someone would have to put that hat on and argue the downside for a particular stock. And we did that because we always wanted to consider alternative points of view, alternative future paths, because you don't want to be surprised by what the market does tomorrow. You want to be thinking through some different options. So honestly, I think about when I call it probabilistic analysis, it's really like a choose your own adventure book for the markets and
Hmm.
thinking about these different scenarios that could happen. So I often will post on my YouTube channel, all right, here's 4 different things that could happen with the S&P over the next 6 to 8 weeks. Here's the super bullish scenario where the S&P blows out above 7,000 and goes to 7,200. Here's the super bearish scenario where the S&P is testing the 200-day moving average. Here are some kind of middle scenarios where it's more choppy or volatile and it's limited movement. And the reason to lay out those scenarios is to force ourselves to get outside of our biases, to get outside of our own thesis and consider alternative points of view, right? If you're all bulled up on stocks, to think about what the bear case looks like and think about particularly what the charts would do, right? What would this chart do? What level would be broken that I would think, okay, that now tells me we're in a bear scenario? What would different indicators I follow? What would breadth do? What stocks and groups would lead or lag in these different scenarios? So by thinking about these different, outcomes, then we can start to assign probabilities. Okay, I think the
Hmm.
most probable outcome is this scenario number 3, a mildly bearish scenario. That's how I'm going to position myself. But I also want to think about these other scenarios. So if the evidence starts tilting way bullish, like I'd already laid out ahead of time, then I know I need to pivot my portfolio a little more on offense. So if you like Choose Your Own Adventure books as a kid, which I
Loved
think you
them.
and I both did,
Loved them.
it's this is basically, I think, a really good way of thinking. And remember that there's just not one predetermined path for stocks. There's a lot of different things that could happen. So think about it ahead of time. This is what we would do in an institutional environment. We'd get in a room and just debate different scenarios, and that helped us to get ahead of those shifts because we'd already thought about what they might look like ahead of time.
Yeah, and I think it's part of that that preparation part, right?
Yeah.
And here again, the analogy that I often use is, in the military, the whole purpose of boot camp is to put you through the ringer, put you in all these different situations so that when you're in the battlefield, you don't freeze up. And,
Yeah.
look, you still might freeze, but at least, you're kind of prepared. It's not your first time hearing a gunshot. You don't
Yeah.
want that to be the case. You want to have kind of thought things through a little bit more.
Yep.
And, to your initial point, this is where your weekend routine, your monthly routine, all of these things where you do take that step back when it's not the market buzzing at you the entire time, that can be a really good time for that reflection of, okay, what do I think can happen here? What's my thesis? And more importantly, how would I react
Yeah.
to those different scenarios?
And I think honestly, it goes back to our earlier comment about confirmation bias. One of
Yeah.
the, I think, ugly impacts and ugly outcomes of our over reliance on social media in 2026, it becomes an echo chamber, right? So
Oh yeah.
my Twitter feed, my X feed is filled with a bunch of growth oriented, technically oriented investors. So if I'm looking to challenge my thesis, my X feed is usually not a great place to look. But
Hmm.
by, really forcing myself to say, okay, I'm bearish on Bitcoin. I just don't think it looks good. All right, what's the bull case look like? Let me actively search for people that are bullish on Bitcoin and get inside their head a bit. What are they talking about? What are they reading? What are they seeing that I'm not? And again, whether or not you end up agreeing with them, it just helps you to think about and maybe even just challenge your own thesis in a healthy way. But thinking about different outcomes as opposed to just the one that you've decided on, a much more, I think, holistic and mindful way of thinking about your portfolio.
Yeah, no, that just really, really makes sense. And again, I'm going to go back to Bill O'Neill, who sometimes, would tell people, look, if you're a conservative, watch CNN and MSNBC every now and then. If you're, diehard liberal, watch Fox News every now and then, and just,
Yeah.
again, so that you're not necessarily just exposing yourself to one side, that you're kind of looking at other sides. And that's true, I think, of whatever you read. Be very careful of, again, what data you're kind of putting in. Right.
And I and
you know
no, and honestly, Justin, I mean, there are issues, I think many issues with artificial intelligence. One thing where I think AI can be really helpful, which is one of the ways that I use AI tools even today, is say, here's what I'm thinking is happening. Can you share with me some people or points of view, some videos that give me an alternate hypothesis? It's actually very good at uncovering other points. Can you articulate
yeah.
the opposing point? And again, whether or not you're not using it blindly, you're just using it to sort of have a check on what you're thinking. It's super valuable for that, and it'll surface things that you probably have not thought about that you should.
Hmm. Couldn't agree with you more. I love using AI for that exact purpose
Mm.
myself. You can. My problem is that sometimes I'll get into a whole long conversation like, but what about this? But what about this? And then it's like, okay, honey, you're coming to bed, right? And I'm like, so. um, okay, David, I want to kind of end this with by just throwing some stocks out at you.
Yeah,
Some of these were some stocks that you're talking about. Ross Stores, ROST.
yeah.
Again, a lot of these, gosh, phenomenal moves in some of these retailers. And as ugly as yesterday looked, today, completely different story.
I mean, big earnings win, and I think the chart of Ross stores for me has been a great reminder. I mean, this has been one of my go-to charts to show people. It's kind of like how you brought up the equal weighted S&P.
Hmm.
How bearish do I want to be when there are charts like this that are out there? And so you have to disconnect my feelings on the market indexes versus my ability to identify stocks that are in strong positions. And there are a number of consumer names, a number of apparel names that have looked remarkably strong, consistently strong. And so every issue I have with the chart of the S&P, every issue I have with the chart of Broadcom or Nvidia is not the case here, right? We're making a pattern of
Yeah.
higher highs and higher lows. We're above upward sloping moving averages. The volume has been decent. The relative strength has been strong because of all of the above. And so the question going into this week is, in my opinion, with a chart that's been working like this, do earnings validate, right? Do the outcomes, do the expectations that come out of earnings sort of fuel additional buyers that are willing to come in and continue to pay more? And at least for today, it appears that that's the case, right? Strong earnings result, continued uptrend. And so this is a type of chart I consider innocent until proven guilty. It's up a ton already, but strong charts tend to get stronger. That's one thing I learned from How to Make Money in Stocks by William O'Neill. That's something I learned from reading, IBD every day, was the fact that there are always strong charts out there. I think ROST has been one of those great examples of innocent until proven guilty. Stick with winning trends until the chart tells you it doesn't deserve a place in your portfolio anymore. Still a good chart.
The trend is your friend until the end when it bends, right?
That's
Okay.
right.
Now, on the flip side, Target, has been in this more serious downtrend,
Yes.
but it's back above its 200-day moving average line and really kind of showing some signs of life now. What do you kind of, how do you kind of handle something that has been just kind of driven into the dirt for so long?
Yeah. It's so interesting, and this, I think, it shows you how much the markets have now evolved in the last couple months, where charts like Target that have been chronic underperformers, have been in consistent downtrends, are starting to change. And when I think of markets in a downtrend as in a distribution phase, right? We're
Yeah.
making lower lows, lower highs. We're below moving averages. The relative strength is underwhelming. What you look for is all of those pieces of evidence to change, right? We stop making lower highs, we make higher highs, which Target started to do going into the new year. We stop making lower lows, we start to make higher lows, and Target finally retested its
Hmm.
lows in the third and fourth quarter, started to rotate higher. We've gone from being below the 200-day moving average for a long time to all of a sudden being back above the 200-day moving average. So this goes back to that, checklist on a piece of paper. What sort of attracted me to Target, earlier this year, was the fact that all of those things that made me want to avoid that chart, all one by one, had changed. And now it's showing signs of accumulation. And that rotation from a distribution phase to an accumulation phase is really not generally happening in the technology sector, with some random exceptions, but generally those have done the opposite. It's almost like Target's kind of like Nvidia flipped over, right? Or AMD
Hmm.
flipped over, these long uptrends that are now showing clear signs of distribution. So we've seen flows away from those leading growth names and into charts like Target. I think that's where the opportunity set is going to continue to be going into the second quarter, with some of these formerly beaten down names that are really starting to improve on a relative basis.
Hmm. Um, since oil is on everyone's mind, let's take a look at Marathon Petroleum, ticker symbol MPC.
Yeah.
This had, look, a legitimate pattern that you could buy off of here,
Yeah.
but it also, you could see where news can really toss this to and fro. So how do you handle something like that, where, oh, the chart is telling me, hey, this is something that's buyable, but
Yeah.
the news of, wow, things could change in an instant. How do you handle that risk?
It's always a challenge, right? And I think when you're buying individual stocks, when you're buying equity ETFs, that is one of the risks you're accepting, right? And the
Hmm.
risk of, or the opportunity for greater returns comes with an unspoken agreement that you're taking on additional risks. And so I think that volatility risk has been something I think a lot of investors have woken up to, is, when I buy equities, I'm going to get some maybe more volatility than otherwise, and we're certainly seeing that. What's interesting is a lot of oil companies, oil services, right? If you look at like the OIH,
Yeah.
these charts have been doing pretty well for a while now, right? This is not a news story that just happened. A number of stocks in the energy sector have had very strong starts to 2026 and have really
Well, I
started to
would say
emerge.
some of that did start with Venezuela, right? There was
A
kind of,
hundred percent. Yeah,
yeah,
right. And so we've seen a number of catalysts, but
yeah.
the charts for me, it's less about what do I think about the implications from Venezuela. It's more about, is this chart breaking out? Is this chart
Yeah.
showing the characteristics of healthy accumulation? And if so, then I'm going to want to follow that trend. And so I think we saw that first with like oil services, before that with like infrastructure names.
Hmm.
And now you're seeing it broadly with oil related companies that generally are a play on crude oil prices going higher. So some of those names, like the OIH, has already had a really good run, pretty extended. A chart like MPC just starting to emerge from a basing pattern. And I think what we saw going into this week is those stocks finally getting that injection of optimism on crude oil prices. Those are pushing the stocks up in a short period of time very, very quickly. But I think the setups are sound. And I think the break above resistance is meaningful on MPC.
Hmm. One more stock for you, because another area that is certainly getting a lot of attention, and there's a lot of different ways to play this, the aerospace defense space. So this is the
Yeah.
Global X Defense Tech, XAR. This is the Spider. There's ITA, which is the iShares version.
Yep.
But let's go to kind of this real steady mover. Howmet Aerospace, HWM, and I'm going to go to the weekly chart because this has just been really an incredible move. So, with something here that could potentially be a catalyst for the aerospace industry, but something
Mm.
that's already been moving for so long, how do you kind of I don't know. Do you have to curb your enthusiasm here, or is it just like, oh well, if it was doing well before, and now you've got something that could push it even higher, and it's not like the earnings have settled down. I mean, look at this earnings line. It's just been in a very nice, steady uptrend along with the chart.
Yeah.
So how do you kind of um, circle this one?
So I love what you did, even bringing up this name, because you immediately brought up the weekly chart and you focused in on what is, I think, one of the great stories. Besides the fact that the price has been consistently going higher for a couple of years, it's the fact that the earnings have been going higher
Yeah.
consistently for a couple of years, right? So if there is one thing, and I learned a lot of stuff from my time at Fidelity, but one of the big takeaways working with a bunch of fundamentally oriented investment managers was price follows earnings. So if we can
Hmm.
get the earnings right, we can get the stock right. What we would often find, though, is in the short term, there could be a disconnect between price and earnings. And that's why technical analysis was an important part of the decision making, because we want to make sure that we have good companies, good stories that also have good charts that tell us investors are agreeing with their thesis. And so I think HWM is a fantastic example of the long term chart. In the daily chart, you see a lot more volatility, a lot more fluctuation. When in
Right.
doubt, zoom out, bring in the weekly data, and you can see how this is a long term story. Just more recently, right, in the last 6 months, we're starting to see a lot of aerospace and defense names look remarkably strong, right? And that came from sort of the US isolationist sort of approach. A lot of European governments, expecting to ratchet up defense spending, conflicts in around the world, really. But I mean, this most recent conflict is almost the latest that we've seen out of a string of catalysts that are causing this space to go higher and higher. So Howmet's been on my list for a while. This most recent upswing feels like the latest catalyst that just confirms that it's a long-term growth story. So I think for me, it's the long-term story. It's the weekly chart that excites me, and not the daily breakout that we just saw, in the last couple weeks.
Yeah, one thing I just want to point out is that the EPS growth rate, this is an annual growth rate for this stock, is at 39%.
Yeah.
And the stability number, 11, the lower number here, it goes from 1 to 99. The lower number means more stable. And so it's just, you usually don't get an EPS growth rate that high that's that stable. Usually if it's that high, it's all over the place. The standard deviation is just crazy, but this
Yeah.
has just got very, very
And
stable
we
earnings.
and the reason why this name was one I wanted to share. I did a sort of a fantasy stock draft with a couple stock charts contributors last month, and we had to pick a certain number of stocks in each sector, and HWM was my only pick in the industrial sector, and the reason was because of the volatility and uncertainty and choppiness in the current market environment. I think it's a great reminder of the way that you navigate through those choppy, volatile periods. Look at long-term growth stories, right? And those are the names that have been able to navigate through some of that choppiness before. I like to stick with those until the chart says it doesn't deserve a spot anymore.
Hmm. Wise again. Wise words again. David, Such a pleasure having you on. And I am going to be on your podcast. So there's people should know again. You do that scenario analysis that you talked about. You have your chart. This you've got a lot of stuff on a lot of content on YouTube. A lot of great stuff there. So I'm honored to be on your show. I think we're going to be doing that next week. So
Yeah,
people can also follow you at D Keller CMT. Your website is Market Misbehavior. Is that .com?
that's right.
I just have it bookmarked, so I haven't typed it in a while. But yeah, marketmisbehavior.com. And anywhere else that people should look for you to get your thoughts on things?
I think that'll probably do it on my YouTube channel. The podcast has been a ton of fun. I actually just interviewed George Noble, who was one of Peter Lynch's assistants, and
Okay.
turned into one of the top portfolio managers in the world at one point. Just interviewed him, and Justin Nielsen will be on my podcast next week. So I'm
Well,
excited to have you on the show. Actually,
I
it's
don't
gonna be
know
a
that I
lot of
want to be
fun.
following George Noble, but
No, it should be
maybe.
great. But no, I'm
Uh,
I'm I'm uh, I'm excited to chat with you then. But in the meantime, no, thanks for inviting me on, Justin, and thanks to Mike and the team. You guys doing a fantastic job with the podcast. I'm a fan.
Awesome. Thanks a bunch, David. Really appreciate it. That's going to wrap it up for us this week. Thank you so much for watching. And next week, we're going to have Jay Woods back on the show. He, of course, had a lot of time as a floor trader down on the New York Stock Exchange. So he's always bringing in that experience from those decades that he's been. And at one point, I think he was labeled the mayor of NYSE. He, of course, is now chief market strategist for Freedom Capital Markets. So it'll be a great time chatting with him again. So hope you join us for that. Thanks for watching, and we'll see you next time. Bye bye now.